The opinions voiced in this program are for general information only and are not intended to provide specific advice or recommendation for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial advisor, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC.
Hey, welcome to our video blog. You know, when we create a financial plan, we have different spots on that plan, and it doesn't have to be too complicated. You have your checking, you have your savings, you have your long-term investments, you have your insurance, and you have your retirement. Now, what I want to talk about today are aspects of investing that deal with long-term investing and your retirement investing. And really, we break these down into two major areas. The first is what's called probability portfolio. Let me give you an example. A probability portfolio might be a mutual fund or a variable annuity, both of which are offered by prospectus, and it can explain to you the costs, the concerns, and the probability is based on history that they'll do a certain percentage or have done a certain percentage. Now, the probability is this: there's no guarantee. There's no guarantee to that. You just have to look back in history and say, hey, look, this is what it's done. Do you expect it to do it moving forward? The second one is what's called a safety first portfolio. Now, the safety first portfolio generally has safety as its main criteria. Here, you're trying to grow your assets. Here, you're trying to either maintain your principal and or produce an income. Now, when you look at these, you generally have three different objectives. The first objective is growth. You want your principal to grow. And oftentimes, people will use a probability-based portfolio, like a mutual fund, like a variable annuity, to try to let their assets grow. No guarantees, but we're looking at history and the probability of that. The second portion is that safety first. You want something guaranteed. Now, let me be very, very specific about the word guaranteed. Guarantee is only as good as the company or entity that is issuing that guarantee. For example, you can have guaranteed bonds issued by Brazil, Venezuela, and even though they're issued by those countries or entities, the principal may default. You can have guaranteed by companies in the US, they may default. So the guarantee is based upon the issuer's ability to pay that principal upon maturity. You hear oftentimes about FDIC insurance or insurance companies in guaranteeing the principal. But remember, they're only as good as the company ability to back that guarantee. And the third type of the portfolio is income. And there's all sorts of investments that produce income. Funds can produce incomes. Variable annuities can produce income. Bonds, CDs. There are certain products that lend themselves. Now, if you take a look on these three here, there's none that are perfect. There's no guaranteed investment that's going to absolutely grow its principal and produce you a lifetime income. That won't happen. But what will happen is when you take these, make a plan, you decide, well, I want to put so much up here, or Dave, tell me about this, or how much should I have? And you create a portfolio where you know a certain amount of money is invested for growth, A certain amount is guaranteed, and a certain amount is going to pay you an income. And you figure that out by coming in here, and the first thing we talk about are your living expenses. When people come in here, they may be very close to retirement, they may be just starting off. But we talk about the dreaded B word, budget. And it is very important to know your budget. If you've paid bills and lived together for years and years and years, retired couple, you can go back in your checkbook, or maybe it's QuickBooks. But it's very important to find out what your budget's going to be. We know your expenses. Maybe there's going to be some unexpected expenses we have to talk about. New car, vacation, want to buy something for the kids, want to buy something for the grandchildren, a college education, whatever it might be. We figure this out. We talk about probability. We talk about safety first. We look at growing some assets, guaranteeing some assets, providing some income, creating your portfolio, and then monitoring. Now, how much should I put in growth? How much should I put in guaranteed? How much should I put in income? Well, that's going to be in large part to A, your expenses, because you're going to need to make sure that your expenses are taken care of, and B, what amount of risk you're willing to take. And in the next segment of the program, what we're going to do, we're going to talk about a program that we have called Riskalyze that's available on Facebook of Workman Associates that will tell you how much risk you should be taking based upon the way you answer the questions. And if you already have an existing portfolio, we can tell you how much risk is being produced by the investment that you have right now. So we'll talk to you in just a minute. Welcome back. Let me correct something from the first part of the video blog. Our Riskalyze is on our website, Workman Associates. But here's a picture of our website right here. And you scroll down and you'll see this, what's your risk number? What's your risk number? And when you click this, it will start asking you questions. Are you willing, would you rather have a 10% gain, or would you rather have with a 1 out of 2 chance of losing 5%? And it'll ask you different questions about how much gain are you willing to take, how much loss are you willing to take. And after you complete these questions, it will assign you a number. Now the great thing about this number is that once we have this number, we can compare this risk number to other parts of your portfolio. And you don't even have to have them here. We can manually input those if you so choose. It's better if you have them here, but we can manually input them. So anyways, once we get this risk number, it will say, let's say your portfolio is worth X number of dollars. We'll just say $100,000. It will say there's a 95% probability, obviously not guaranteed, but a 95% probability that in 6 months, the $100,000 will be in this particular range. Just using numbers, 115,000 to 94,000, we'll say. And we'll see whether or not you're comfortable with that. And then what's also great about this Riskalyze is it goes through different scenarios. I call them the good, the bad, and the ugly. The good is when the markets really did well, like in 2013. How would the S&P be measured? How would your portfolio have been measured? And how did they do during that good period of time? Now there's the bad period of time. That's when we had a bear market, meaning when a year that the market went down exceptionally poorly, not exceptionally poorly, but it went down very, very much. It was 2008, I believe. How the S&P did, how your portfolio did. Then, the ugly, how it did during the credit market crisis from 2007 to 2009. Then we also look at another time period, I believe it was in 2013, when the bond market, interest rates went up 123 basis points, I believe. How did your bond portfolio do? So it gives you a combination of looking at good times, bad times, really bad times, and times that affected the bond market, not just stock markets. So you can see how your portfolio, and this is a very important word, would have potentially acted. And we're not talking about just percentages. It'll put a dollar amount in. In this time period, that $100,000 would have grown to this. In this time period, the $100,000 would have gone down to this. And you need to do it now because we're at a position of strength. What do I mean? I mean that with the markets where they're at right now, not at an all-time high, but at a very good point as of August 7th, 2018. And if you need to make some switches, now's a good time to do it. It's certainly a great time to always know how much risk you have in your portfolio. I've had a number of people come in here that have been prospects, that if I hadn't known how old they were, or if I didn't know how old they were after I'd met them, I'd have looked at their portfolio and been totally wrong. I can look at a portfolio and say, yeah, this portfolio, I believe, for the most part, for most people, would be a 35-year-old because of the risk they're taking, because of the accounts they have. Or this person's probably in their 70s because of how conservative this account is. Well, that person might be 52. And while it's all personal preference, hey, this is your money, it's not mine. I'll do whatever you ask, but I'll always give you my opinion. I'll take that back. I won't always do what you ask, because if I think it's a really bad thing to do, I'll ask you to do it with somebody else, because I don't want that burden on when something goes wrong. But what we do is we take a look at your portfolio and we try to tailor-make it for you. And then we monitor it so that, let's say you take this Riskalyze today, 5 years from now, we take a look at it, and as you get older, people generally become more conservative. I'll tell you what else has happened, is that since 2009, when the markets have gone up considerably, people have forgotten about risk. They've forgotten about how bad it was in 2007, 2009. And I always have been taught from my very early career that you try to educate and teach your clients about what isn't happening. Right now, it's been very, very good for the last number of years. First quarter of 2018, kind of flat. Same with the second quarter of 2018, not great, but up a little. But overall, for the last 7 or 8 years, we've had a pretty strong market. People have forgotten about risk. And that's why we've introduced Riskalyze as a free offer to you so that you can find out exactly how much or how little risk your portfolio is taking. I highly encourage you to try it, folks. You need to take some time to find out. I will monitor it the best I can, but especially for prospects, take a look at it and give us a call. And so, thanks for listening to my video blog. Be sure to, excuse me 1 second while I go off camera. Be sure to support a great time. Carousel Fund Days, the last Saturday in August. It's a great time. Support our carousel, take a ride on the train, support all the vendors, because we need to support our local businesses. We need to support our local activities. Thanks so much. Talk to you soon.